If you've ever bought a so-called high-yield dividend stock only to watch the dividends disappear quicker than a pint of Guinness on a Friday night, then this is the video for you. Today, I'm walking through 3 dividend stocks currently on my watch list. There's no hype, there's no wild price targets, there's just solid companies with reasonable valuations and income that you can actually rely on. Now, if this sounds like the kind of research that you'd like, then please feel free to check our link to our newsletter in the link below. Now, let's start with a solid British dividend player, Legal & General, ticker symbol LGEN. Now, Legal & General are not exactly glamorous, but let's be honest, that is not the reason why we're here. This insurer has been around since 1836, and today it's offering well over 8% in dividend yield. Now, usually that can be a red flag, but in this case, it's backed by a few reassuring numbers. The solvency ratio is over 200%. That's basically a measure of how much financial cushion they have. Insurers are highly regulated, and anything above 150% is generally seen as really healthy. So 200% means that they got enough room to absorb any shocks and still keep paying that dividend. Now, Legal & General runs 4 different business lines, but the most important by far is its institutional retirement business. This accounts for nearly 50% of their overall profit. The other segments are investment management, retail products, and capital development. These are far less exciting. In fact, investment management has been seeing falling margins due to fee pressure, but it's still a nice complement to their core business, which, as I said before, is institutional retirement. Over the past 5 years, profit after tax has only grown at around 3.6% annually. That's pretty slow, but these profits are consistent, and crucially, they are not reliant on borrowing or any kind of financial engineering. We estimate a fair value at around 353 pence, so at its current prices, it's probably around fair value. Now, with all investments, there is some risk associated with them. And if you think about it, given that their largest segment is their investment portfolio, if the stock market takes a dive, this could hurt their earnings quite bad. But overall, this is a company with strong capital, high returns on equity, and a track record of paying out increasing dividends. Next up on the list is Sysco, ticker symbol SYY. Now, Sysco deliver food to over 600,000 customers across the US. Think about restaurants, schools, care homes, and even hospitals. Now, Sysco have been around since 1969, and they have quickly grown into the largest food distributor in the US. It has roughly around 16% market share. Now, this scale gives them a couple of things. It gives them serious pricing power and also cost advantages over smaller competitors. Their dividend yield is roughly around 3%. But it's not about the yield, it's about their reliability. And Cisco is a dividend king. This means that they have grown their dividend for over 50 years straight. Now, that is dividend increases through recessions, inflations, pandemics, you name it, they have increased their dividend. Their payout ratio is around 50% of forward earnings. That's kind of a good middle ground. It's high enough to reward us shareholders, but low enough to keep increases sustainable. They're also paying out about 50% of free cash flow. This means that the dividend is well covered by actual cash coming into the business. Now, like Legal & General, they also generate strong returns. They generally return around 20% of capital employed. That's well above average, and that tells me that management is using our shareholders' money quite effectively. Now, it's not all sunshine and roses with Cisco. There is a downside, and that is the amount of debt on their balance sheet. Now, Cisco took on a fair bit of debt during the low interest years, mainly to buy back shares. Their debt to equity is quite high at nearly 6. That means for every dollar in equity they have, they've got nearly $6 in debt. But it is definitely something to keep an eye on. On valuation, it trades at around 18 times earnings. Now, it's not a deep value play here, but I would not say it is expensive either for a staple defensive business. For example, in recent quarters, they posted around 2.7% sales growth and around 5.2% profit growth. It's not fireworks, but it's just a steady, mature business. Now, last on the list, we have Merck Co, ticker symbol MRK. Now, this is a US-based pharmaceutical company with a global reach and one of the biggest drugs, if not the biggest drug, in the world. And that drug is Keytruda. This is the best-selling cancer treatment drug in the world, and it is responsible for a sizable chunk of Merck's revenue. And while it is nice that it can generate over $20 billion a year, that presents its own types of challenges. Keytruda Keytruda's patent expires in 2028, which means Merck needs to find something new to fill that gap. Now, to their credit, management is not sitting still. Merck is pouring cash into R&D, and drugs like Winrevair and MK0616 are in the pipeline and showing lots and lots of potential. Of course, this is pharma, so nothing is guaranteed, but the early signs are quite positive. Now, the current dividend yield at the time of recording is just over 4%, which is quite decent. It's grown at roughly 7.7% a year over the last 5 years, and its payout ratio is just under 40%. Also, its free cash flow payout ratio is a little under 50%. In other words, there's plenty of headroom to grow this dividend. From a valuation perspective, it is fairly priced. It's trading at about 12 times its earnings, and we estimate a fair value at around $80. Of course, the biggest risk is what happens after Keytruda. If the pipeline doesn't deliver, earnings could drop sharply, and therefore our fair value would look really high at the moment. But to be honest with you, if it does work out, and I personally believe it will, then the market is probably undervaluing them quite heavily right now, especially when you compare them to some of the peers. So if I was to sum up my watch list this month, it will be a high yielding 8% stable and undervalued insurer in Legal & General, a slow growing dividend king but with a little bit of debt, Cisco, and finally a pipeline rich pharma who I believe are reasonably valued in Merck. Now, as always, if you like these type of videos, please hit that like button below, and if you're feeling really generous, also hit that subscribe button. Thank you very much for watching, and we'll see you all next time.